When I learned banking, after graduating from university, I went to a big New York bank. I learned banking back in the 1960s. And I was taught what I call traditional banking. I was taught by guys who'd lived and worked through the Great Depression, obviously, as your grandfather had done. And banking back then was very different. A traditional banking back then was very different. Today, what we still have an element of banking being traditional banking, but that large percentage of profit that's being generated as part of the economy, that's not really traditional banking. That's hedge fund banking. Mm-hmm. That's speculative banking. That's something completely different. And in my view, really doesn't have a place in banking, in the sense that you're taking other people's money and speculating it. And then you ultimately, inevitably make mistakes. Bankers are human just like everybody else, and some losses are incurred. But when you're leveraged so highly, the small loss can wipe out your capital when you're highly leveraged. Again, going back to my experience in the 1960s, back then, if a bank was leveraged at 6 or 7 or 8 times, that was considered to be prudent. If you had 8 times liabilities against your capital. Today banks are leveraged at 40, 35, 50 to 1. Federal Reserve is leveraged something like, I think, 100 to 1, which is what long-term capital was managed at before it went under. It's entirely different what we have today. And I guess this financial genie has out of the bottle, and we have to bring it back to a more prudent, traditional level.
I don't know how we do that, though, because this genie expands rather easily and contracts rather dramatically and unpredictably. So it's almost impossible to think, how do you unwind 600 to a quadrillion, 600 trillion to a quadrillion in derivatives? How do you undo that? We got our first clue, I think it was 3 or 4 years ago. Warren Buffett bought this little reinsurer, Munich Re, and then said, I don't want the derivative portfolio, and spent the next 4 years trying to unwind it. Mm-hmm. And he came out and said, we don't understand it. There's only 14,000 of these contracts. We don't know what to do. We can't value them. We don't know how to, we have to just let them run out, because they couldn't figure out how to sell them, right? Mm-hmm. And that was just one thing with 14,000. When Lehman went down, they had 600,000 of these contracts, and I think they've managed to they've got that down to about half, but it went bust a few years back, and still they're trying to figure out what this thing is. So nobody knows who's holding the bag, where the risk is, or what's going to happen if this thing has to suddenly shrink. And so, of course, we can't get that shrinkage because it's just too frightening.
Yeah, that's why they don't want Greece to default, because everybody who now has little exposure to Greece, but they have exposure through the derivatives, the little exposure may turn out to be 50 billion euros of exposure based on if they're on the wrong side of a derivative contract. Same thing with Italy, Spain, and all of the other countries. But inevitably, we can't continue, so something has to happen. And if we go back to a sound money basis, wouldn't that sort of put the banking back on a more prudent level as it was up until, let's say, the 1960s?
Well, absolutely. There's it's the thing that I find disappointing is so many people dismiss out of hand the idea that we could ever go back to a style of banking that would actually work. We know things that work. We have money systems out there that we've used all through history that can prevent enormous trade imbalances from occurring because they have auto-leveling features in them. We have sound money systems that prevent governments from just spending everything they desire and then some, because there will be an interest rate cap that will come up and eat them from below. We know about this. So sound money, meaning a hard money system of some kind, has been proven through history to provide those somewhat painful but automatic leveling functions. And I think we're going to go back there at some point. I don't see any other way around this besides getting ourselves to a position where we take monetary decisions out of the hands of politicians. And the Federal Reserve I include they're political at this point. They're a political animal. Paul Volcker, I think, was the last truly non-political Federal Reserve chairman. Greenspan I think he visited the White House more times than all prior Federal Reserve chairmen combined. He politicized the whole thing. And so now we have a system, I think, which is clearly out of control. When the United States government is spending 40% more than it's taking in for 3 years running, and is running trillion plus, even trillion and a half plus deficits, when it's spending at a deficit level 9% to 10% of GDP, and frowning at Greece spending 8% of GDP in deficit, we clearly have a system that's off the rails. People detect that. We're seeing protests starting to arise all over the place, social unrest, which is all connected to the idea that something is broken. The story just isn't working.
Yeah. what we need is what we're going through is a structural change. It's not a cyclical change. You know, you made the point in the past that they could step on the money printing lever and the economy would revive, or there would be resources available of one sort or another. But today, when they're stepping on the accelerator, nothing happens. The engine is flooded, so we have to go through a structural change. So that suggests to me this isn't going to be pretty as this thing plays itself out.
No, absolutely not. I think that what's happened here is ultimately business cycles happen. And you need to have regular recessions, and you need to wipe out the bad investments, and it's just a normal part of business. It's a normal part of how humans conduct business. I think all of that's true. 1994, we were going to enter another recession, and Greenspan said, not on my watch. I think that was where this story really started to go off the rails. He did something really extraordinary. He said, well, we need more bank lending. Corporate debt looks like it's in trouble. How can we juice the system? And what he did was he basically removed the reserve requirement ratio completely by enabling something called sweeps programs, where banks could sweep money out of a demand account into a fictitious non-demand account just before the stroke of midnight, take a snapshot, say, oh, there's nothing in our bank that we have to hold reserves against. And it allowed the banks to actually just sidestep the reserve requirements. So what happened next? Well, just credit came out of the woodwork, right? And we had this great internet boom and the stock bubble. And then that started to burst in 2000. What happened? Well, they just ran interest rates down to zero, well, 1% by 2003, close to zero, and got the housing bubble as a consequence. So I see this as a constant series of attempting to deny reality, in essence, that started in 1994, 95. And instead of having a couple of nice, busts along the way, we're going to have one big spectacular bust. I think the crime in this story is the degree to which the rest of the world said, hey, that free money party looks like a great thing. We'll participate too. And the crime in that is that once upon a time, you used to be able to look at how one country was going off the rails and say, I'm going to get my money out of that country. You could cross a border and safely park your wealth somewhere. But when the United States does it, and then the European Union follows along, and then China sort of gets dragged into this whole mercantilist policy, and they're along for the ride. Now let's imagine you're a big pension fund manager. You're responsible for tens of billions of dollars. What do you do? Where do you go?
Tangible assets,
How big is that doorway?
Well, I know, but I think that's basically suggesting that tangible asset prices are still very low and that tangible assets are still relatively undervalued.
Extraordinarily.
I'm talking about tangible assets of all sorts, not just gold and silver,
right.
But farmland, timberland, oil wells, things of that nature, mines, whatever it happens to be.
Yeah, I agree. There's trillions of dollars parked in this fantasy paper world, and someday that's going to start squeezing through into those tiny doorways, which we'll call tangible wealth. And so I think there's enormous upside on the tangible side of this story.
Yeah, it's hot money looking for a safe haven. More and more of it has been moving into the tangible asset side, but I think it's still a trickle. There's a whole Hoover Dam of hot money there waiting to find a safe home. And I guess the question is the sooner somebody moves that money into a safe home, the better off they're going to be in terms of preserving their purchasing power.
Yeah, first mover advantage is extraordinarily huge in this story.
Yeah, let's come back again still to Europe. As I mentioned, we're here in Madrid, Spain. Italian bond yields 7.2% this morning. They have a new premier. Is that going to help?
We can shuffle the cards of leadership all we want, and it doesn't change the underlying basis of this story. The prime story is this. Italy spent more than it was producing. It was consuming more than it produced for a long time, and now it's got a debt burden which is going to have to be resolved through some sort of a wipeout of those claims in some way, shape, or form. Right now, they're looking at, well, the people of Italy are going to have to undergo a lot of austerity. That's probably true anyway. That part of the story shouldn't change. But the idea that Italy can then just undergo a little bit of austerity and somehow correct for all of its past sins is not a workable solution. There's going to have to be an enormous haircut somewhere on Italian bonds as well. But the story doesn't stop there because, of course, Spanish bonds would be next. And where's Portugal? And we look at the fleeing of M1 out of Portugal's system. It's incredible. The money's just been going away. I'm looking at Portugal as another part of this story. Greece, of course, is tiny on an aggregate number basis compared to Italy, compared to Spain, compared to Portugal. So I think where we are in this story is we're at the early stage of seeing these dominoes fall, and it doesn't end there. It progresses from the outside, the weaker members, into the stronger members. France, we're looking at credit default swaps on France. They are now at the highest spreads they've ever been at since even at the height of the 2008 crisis. So this is clearly coming in, and what does the world do? Well, the big money says, well, then we'll go slosh over into the United States, and we'll buy treasuries, and we'll be in the dollar for a while. But that's, again, I think, incredibly short-sighted, because it's to me, that's like climbing up onto the tail end of the Titanic and saying, this is the place to be, right? You know, and
not
it's just
a safe haven.
It's not a safe haven, because the same math, which I could sketch for you, I could get a dollar store calculator and a napkin, and we could prove that the United States is every bit as insolvent with respect to its outstanding debts and liabilities as Greece or Italy or Spain. So the thing that's the mystery in this story is, why hasn't the big money looked at that and said, where can I be? And the only safe places I see right now are tangible assets.
Yeah. What's the answer to your question? What is big money looking at? Why aren't people taking those steps to protect themselves? Do they need a trigger before they get the wake-up call?
I think a lot of it's just normalcy bias, right? So if you're a big money manager, and I have these conversations with people who I consider big money managers all the time, they have a public conversation, which is, listen, this is my job, I have fiduciary responsibilities, I am in many cases forbidden by either the prospectus or by laws from going into certain asset classes, so I have to play in this game. So as long as I have to play the stock and bond game, this is what I'm going to do. And then privately, we close the door and we have a different conversation. And they say, yeah, but what should I do?
Yeah.
Right? And then we have a real conversation about hard money and making their personal lives more resilient and trying to figure out how to truly diversify, which means out of paper currencies into some other asset classes and things like that. And so I'm finding more and more that I'm having private discussions that are very different from public discussions. And that's where we are in this story. But the mistake, I think, most people think, is that we'll have a nice orderly progression and things will sort of reveal, and we'll all sort of figure it out. And what happens, I think, instead is it's a financial world. Everything seems fine, and then it's not. Things change very, very rapidly, and first movers have an extraordinary advantage in this story.
After graduating from university, I went to a big New York bank. I learned banking back in the 1960s. And I was taught what I call traditional banking. I was taught by guys who'd lived and worked through the Great Depression, obviously, as your grandfather had done. And banking, that's speculative banking. That's something completely different. And in my view, really doesn't have a place in banking, in the sense that you're taking other people's money and speculating it. And then you ultimately, inevitably make mistakes. Bankers are human just like everybody else, and some losses are incurred. But when you're leveraged so highly, the small loss can wipe out your capital when you're highly leveraged. Again, going back to my experience in the 1960s, back then, if you were When I learned banking, banking back then was very different. Traditional banking back then was very different. Today what we still have an element of banking being traditional banking, but that large percentage of profit that's being generated as part of the economy, that's not really traditional banking, that's hedge fund